Every day, millions of hard-working people pay their taxes, often wondering how their contributions are being used. Meanwhile, some of the wealthiest individuals in the country are legally navigating around these same tax obligations. Consider this. While the median American household income stands at around $68,000, with a significant portion taxed at up to 22%, the wealthiest, earning millions, often pay a disproportionately lower percentage of their income in taxes. Is it a tale of financial savvy or a question of ethical loopholes in our tax system? Today, we're diving deep into this topic, armed with data, expert opinions, and insights into the financial strategies of the ultra-wealthy. Let's start with the basics of how most Americans are taxed. For the average worker, income comes in the form of a salary or hourly wage. From this, federal and state taxes are automatically deducted. In 2023, the median household income was about $74,580, with a significant portion going to taxes. The tax rate increases progressively with income. For example, a single filer earning $45,000 a year falls into the 22% tax bracket for federal taxes. This system is designed to be equitable, with those earning more paying a higher rate. Now, let's shift our focus to how the ultra-wealthy earn their income. Unlike salaried workers, their income often doesn't come from a traditional paycheck, but from investments like stocks, bonds, and real estate. These assets can appreciate significantly in value over time. The key here is understanding capital gains. When an investment like stock or property increases in value, it's known as an unrealized gain. This gain isn't taxed until the asset is sold. The tax rate on long-term capital gains is notably lower than the rate on regular income. For example, in 2023, the long-term capital gains tax rate was 0%, 15%, or 20%, depending on your income level. For billionaires, a large portion of their wealth comes from these unrealized gains. As long as they don't sell their assets, they don't pay taxes on this increase in wealth. This fundamental difference in how income is generated and taxed creates a vastly different financial landscape for the ultra-wealthy compared to the average taxpayer. Now that we understand the basics, let's explore the specific strategies and loopholes that allow the ultra-wealthy to minimize their tax liabilities. To understand the tax strategies of the ultra-wealthy, let's delve deeper into the numbers. A primary method is leveraging loans against large asset holdings. For example, consider a billionaire with $500 million in stocks. They might secure a loan of $100 million against these stocks at an interest rate as low as 1 to 2%. This maneuver allows them to access substantial cash without triggering a sale of the assets, thereby avoiding the 20% capital gains tax that would apply on such a high-value transaction. Now, let's explore the buy, borrow, die strategy with more precision. Imagine a billionaire's assets, including stocks and real estate, are valued at $1 billion. If these assets appreciate by 8% annually, the increase in wealth is $80 million per year. However, by borrowing against these assets rather than selling, they defer paying capital gains taxes indefinitely. Upon their death, these assets can be transferred to heirs with a step-up in basis, often erasing millions in potential capital gains taxes. Income management is a critical aspect of these strategies. Many of the ultra-wealthy, such as CEOs of major corporations, take nominal salaries, sometimes as symbolic as $1. This approach significantly reduces their income tax liability, which for top earners can be as high as 37%. Instead, their wealth accumulation is primarily through capital gains, taxed at a maximum of 20% for long-term investments, a stark contrast to regular income tax rates. These figures paint a clear picture. While legal, these strategies create a vast financial chasm. The average American household with a median income of approximately $74,580 faces a standard tax rate on their income. In contrast, the ultra-wealthy navigate a complex financial landscape, leveraging tax laws to minimize their liabilities. Let's examine some real-life examples to understand how these tax strategies play out among the world's richest. Jeff Bezos, the founder of Amazon, saw his wealth skyrocket. Yet there were years, like 2007 and 2011, where he paid no federal income tax. In 2007, for instance, Bezos' fortune increased by $3.8 billion due to Amazon's stock growth. However, through deductions and investment losses, His taxable income was offset, resulting in zero federal income tax. Similarly, in 2011, despite being worth around $18 billion, Bezos reported a loss, claiming and receiving a $4,000 tax credit for his children. Elon Musk, the CEO of Tesla and SpaceX, also demonstrated minimal tax payments compared to his wealth growth. In 2018, despite his net worth increasing by billions, Musk paid no federal income tax. Over a 5-year period, from 2014 to 2018, his wealth grew by approximately $13.9 billion, but he paid a true tax rate of just 3.27%. Warren Buffett, known for advocating higher taxes for the rich, also managed to minimize his tax payments. Between 2014 and 2018, Buffett's wealth grew by $24.3 billion. However, he paid only $23.7 million in taxes during those years, which works out to a true tax rate of 0.1%. These examples are not anomalies, but rather illustrations of a broader pattern among the ultra-wealthy. They leverage the tax code through various legal means, resulting in paying a fraction of taxes compared to their wealth growth. The tax strategies of the ultra-wealthy have far-reaching implications, not just for individual taxpayers, but for the economy and society as a whole. When significant wealth isn't taxed proportionally, it affects the distribution of the tax burden and the funding of essential public services. Consider this. The federal government relies heavily on income taxes for revenue. In 2022, individual income taxes accounted for about 52% of federal revenue. When the ultra-wealthy pay a fraction of their wealth increase in taxes, it shifts the tax burden more heavily onto middle and lower income earners. This disparity in tax contributions can lead to underfunded public services. For instance, the American Society of Civil Engineers gave the US infrastructure a grade of C- in 2021, citing a lack of investment. Adequate funding from taxes is crucial for improving infrastructure, education, healthcare, and other public services. The tax strategies of the wealthy also raise questions about economic inequality. According to the Economic Policy Institute, from 1978 to 2018, CEO compensation rose by 940%, while typical worker compensation only rose by 12%. This growing disparity is partly attributed to the different ways wealth and wages are taxed. Economists argue that when wealth accumulation at the top isn't adequately taxed, it can lead to a concentration of wealth and reduced economic mobility. This concentration can influence political and policy decisions, further entrenching economic disparities. On a community level, the reduced tax contributions from the wealthiest can mean less funding for local programs, small business support, and community development initiatives, all of which are vital for a thriving society. The tax strategies of the ultra-wealthy, while legal, present a challenge to the principles of fairness and equity in our tax system. They prompt us to consider how this system could be reformed to ensure a more equitable distribution of the tax burden and better support for public services and infrastructure. The structure of the US tax system has undergone significant changes. In the early 20th century, the top tax rate was as high as 91% during the 1960s. Today, the top federal income tax rate stands at 37%. However, the effective tax rate, what people actually pay after deductions and credits, can be much lower for those with substantial investment income. In 2022, individual income taxes constituted about 52% of federal revenue. Payroll taxes, which fund Social Security and Medicare, made up 34%, while corporate taxes accounted for only 7%. This distribution highlights the reliance on individual income taxes for federal funding. The top 1% of earners contributed approximately 40% of federal income taxes, but the tax rate on investment income is often lower than the rate on wages. For example, long-term capital gains are taxed at a maximum of 20% compared to the top wage income rate of 37%. This disparity in taxation contributes to wealth inequality. From 1989 to 2016, the wealth of the top 1% grew by over 300%. While the bottom 50%'s wealth remained relatively stagnant. The different tax treatments of wages and investments play a role in this growing divide. The debate over tax fairness and reform is ongoing. It's a critical discussion that impacts not just the wealthy, but every American citizen, influencing public services, infrastructure, and the overall health of our economy. As we conclude today's episode, the tax strategies of millionaires and billionaires reveal not just individual financial acumen, but also underscore broader systemic issues within our tax framework. These strategies, while legal, highlight the complexities and disparities of a system where income from work and wealth are treated differently. We've seen how the ultra-wealthy can leverage their assets to minimize tax liabilities, a luxury not afforded to the average wage earner. As we continue to navigate these complex economic waters, it's crucial that we stay informed, engaged, and proactive in shaping a tax system that is fair, efficient, and reflective of our collective values. Thank you for joining us on Finesse the Market. Don't forget to subscribe for more insightful content.